Breaking news coming in. Retail inflation rises to
It's a big increase. Inflation has clearly risen.
but inflation likely to surprise hugely on the upside.
Inflation rates have reached a 14-month high, which no one was expecting, including the government probably. Today, RBI is faced with two interesting choices. One is either to control inflation or to boost economic growth. It's going to be very interesting to watch what happens. What the RBI decides would actually decide which way the Indian economy is headed.
Hello and welcome to Cut the Noise, a show where we decode market trends and uncover insights that matter the most to you. The latest inflation numbers for October have left the RBI in a dilemma. Should it focus on boosting India's growth or prioritize controlling inflation? It's a tough choice and only one path can be taken. So what will it be? Let's dive in and explore. To help us make sense of this trend, we have with us Mr. Ankit Dukania, who heads the finance team at GRIP. And we've got just the right person for you for this topic.
Great to be here. Thank you for inviting me.
What is it about the inflation numbers of October that has taken everybody by surprise?
Yeah, if you see the inflation number that came for October, it reached north of 6%, while everyone, including myself, I was expecting it to be below 6%. That has taken everyone by surprise, including, I guess, RBI itself. And if you see the reasons for it, right, when you say inflation, it contains 5 different baskets. One is food and beverages, second is housing, third is fuel and light, fourth is your clothing, and fifth is miscellaneous. Out of these 5 different heads, if you see, almost 50% of inflation weightage is given to food and beverages. Few reasons for this to happen is obviously a bad monsoon, and then there were certain custom duties on edible oils which the government put in to support local farmers. So that's again a political move, and then geopolitical tensions that we are currently undergoing. So all of these have led to inflation rate which is north of 6%, which no one was actually expecting.
And so, in such a situation, what are the tools available with the government to control inflation?
See, controlling inflation is primarily the duty of a federal bank. In our case, it's the RBI. So to control inflation, right, RBI has many tools. The most widely used tool by any federal bank is repo rate. Repo rate is nothing but the rate at which RBI lends to banks. So you see in India, the repo rate is decided by the Monetary Policy Committee, which is a committee under RBI. Now, if the RBI realizes that there's high liquidity in the market, which is leading to an inflationary trend, it would increase the repo rate so that the fund flow in the market and the economy decreases.
Basically, when RBI increases repo rate, it makes borrowing more expensive.
It made borrowing for the banks more costly, expensive. In turn, they would lend at a higher rate, so which would reduce the money flowing into the economy. Now, the challenge with this is obviously this helps in one objective, but then it defeats the other objective, which is also to maintain the growth of the economy. If there is no liquidity or not enough liquidity in the market, the economic growth would suffer. So it's a very challenging decision for RBI or any federal bank to maintain a balance between these two objectives.
Okay, so given the inflation data that we have, what do you think is RBI's best move?
Before the October inflation data, everyone was expecting that the RBI will reduce the rates to improve the economic growth. So given the inflation data that has come in, RBI has very little room to reduce the rate further, because RBI actually wants to do that given the economic slowdown that is there. So given that premise, RBI was actually looking to cut rates in this meeting. With this inflation data, that becomes a very difficult thing to achieve.
And also, there are signs of the Indian economy also slowing down, right? We're seeing exports which have slowed down. We are even urban consumption has reduced. Okay, and so one last question before we close this, Ankit. What impact does this have on the bond market? Because it's very related to the interest rates.
Yeah, actually, inflation rate basically it impacts bond yields in 2 ways. One is inflationary expectation, right? Now, taking an example, if I'm expecting that the inflation rate is going to be high, right, that would reduce my purchasing power. So that means the bond that I'm currently holding has a lesser value in future. So the yield would improve. So the price of the bond will go down and the yield would improve. And if you see the RBI 10-year yield, that has actually improved by 10 bips. And the other way inflation impacts bond rate is basically the central bank policy, because a higher inflation would mean that RBI has to increase the rates further to contract the money available in the market. So that means if today I'm holding a bond of, let's say, 10%, and I'm expecting in future the bond rate would go up. So the bond that I'm holding today, the value of that bond would reduce and the yield would improve. So these are the 2 ways inflation rate would impact bond prices.
Okay, that's very interesting to know. Thank you for sharing your wonderful insights with us. With inflation high and growth slowing, RBI does face a tough decision between stability and support. We'll keep an eye on how things evolve. Till then, Keep watching Cut the Noise and don't forget to like, share and subscribe to Grip's YouTube channel. Thank you.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer related documents carefully.